Now let me also give you a little bit more background before we move ahead. Typically, let's take a family or a household. We know that there are incomes in a family by way of say salary or interest income. We also have expenditures in nature of grocery, electricity bill, telephone bill, education expenses for children, and so on and so forth. We also, households also buy, for example, assets such as a vehicle or a home or jewelry. And this is normally, they will look to fund from their income, their salary income or interest income which they have. Now, if it is not sufficient to buy the assets, the income is not sufficient to buy the assets like house or vehicle, then they might approach an institution like a bank and ask to lend them some money which they can repay through their income. But once this process is on, every family or every household would like to also take stock of the situation from time to time. Say every month they would like to know what were the total income that they had in the family, husband, wife, interest, etc. Then how much did they spend actually? Was there a surplus or was there a deficit? And then they can also make an assessment as to what the borrowing level is, how much have they repaid, what is the outstanding amount to be repaid, etc. So what are we doing? We are essentially in the household understanding as to what money flow is happening within the household and where all this money is lying. Is it lying in the bank, or is it lying in the form of a house, or is it something that is being expended by the family? So this sort of information, when we put it together, is what an organization will also want to do. For example, when an organization or any organization like a family, when money flows in or flows out, or when it has to buy certain assets to do the kind of work that organization is doing, and maybe it has to borrow some money for that purpose, a very similar approach is taken by the organizations also. So it is not very different in terms of the concept, the basic approach which a household takes, the same kind of approach an organization will also take. And basically the way you put the money inflow, outflow together in the form of your notes in the paper in a family or a household is what accounting is all about. That basic understanding, once you have, it makes it much more easier for you to get into what an organization does. So let us now look at the scope of this discussion that we have undertaken now. Essentially, since I mentioned organization, we will look at the various organization types that we can come across, which actually have money flowing in and flowing out, and therefore has some need for recording this inflow and outflow, and then assessing the financial status. We also will see what is the purpose of maintaining this inflow outflow in some form, and why should there be this financial statement at all. I mean, why should I make this assessment from time to time? Why I need my financial position to be clarified from time to time? Who are these people who may require to know about the financial status? Then, to convey this financial status, what are the different types of financial statement that are normally made by organizations? We also will go into understanding the accounting concepts that go in preparing these financial statements, and also we will see in terms of when I mention that I have so much of asset or we have so much of liability, what is the basis of how to value these assets when I am presenting them in the financial statement. So let us start off with looking at the organization types. Typically, we can see that organization can be for profit purposes or non-profit purposes. Companies like ITC, Reliance, your Bharti Airtel, etc., which do business, which do for profit motive, are profit oriented organizations. Also firms which are like, they are not companies but firms like KPMG, which are consultants, or Ernst and Young, or some legal practices they also have a profit orientation in mind. But there could be organizations which do not have any such motive, such as charities, clubs, university, etc., which you might know about. Our focus would be on profit oriented organizations. But before I go to that, let's just broadly define what an organization is all about. An organization is a social arrangement for the controlled performance of the collective goals, and this controlled performance of the collective goals, when this arrangement has a boundary vis-a-vis the environment in which it is operating. Now let me just take you through quickly to make it a little more clear. It's a social arrangement. When we say that, means people are coming together to do something, and that do something has a collective goal. There is some goal which is common to all of them, but it is not necessary just because people have come together to achieve a goal, they will do anything and everything to achieve that goal. There are controlled performance, means there are some rules, regulations, some internal procedures that are laid down to achieve them, and this arrangement is differentiated from the environment. Now what is this environment we are talking about? We are talking about the government, the customers of the organization, the suppliers to the organization, the banking system that exists outside of the organization, etc. So this is what broadly talking about an organization is defined as. Obviously, as I said before, our focus will remain on those organizations that exist to make profit, which in other words are also called as businesses. Now when I say a business, I can have multiple views of how to look at a business. Some may say that it deals in manufacture and purchase and resale of goods and services. Some may say that they use resources, economic resources, such as human capital, that is people, such as machinery or building, etc., and then they create products and services from that, and then they sell them. Another view can be an organization is there to provide jobs. But from our perspective, the view that we would like to take is, it is an organization, a business is nothing but something which puts money into resources with a view to make more money. What are these resources? It could be, as I mentioned here, buildings, machinery, people, etc. But there is a motive, there is an objective, and the objective is to make more money for its owners. This definition goes along with our so-called profit motive. The idea is that we need to make profit. So the accounting that we are going to learn is of those organizations that have this kind of a objective, which is to make profit for its owners. While now this is applicable across, it could be a single owner organization, like, or a person like a plumber or a carpenter, whose requirements of keeping his accounts or money inflow and outflow could be very simple, to a multinational company or corporation which has factories all over the world, which has sales offices all over the world, where the accounting process can become extremely complex. But nevertheless, the objective is to make profit. Profit, as we know, can be simply defined as income, excess income over expenditure. If we are not making excess income over expenditure, we are making a loss. While it looks very simple, as we will understand as we go on, that in a simple organization, this definition works pretty well, because it is easy to identify what can be treated as income, what are the various elements of expenses, and how the profit can be arrived at. But the larger and the more complex an organization becomes, for example, like a multinational corporation, then income, expenditure, definitions itself can be a lot more gray, and profit is not as simple as it appears to determine. Anyway, we will look at that in a subsequent session.